The Collins Amendment was part of the Dodd-Frank Act that was passed in 2010. Basically, what the Collins Amendment does is disallows banks from using these things called trust-preferred securities to raise Tier 1 capital, which is, for regulatory purposes, is the highest quality capital. What trust-preferred securities are a hybrid instrument that have both characteristics of both debt and equity. Essentially, a bank holding company will establish a non-taxable trust. That non-taxable trust issues preferred securities to investors, and then when the investors purchase those securities, the trust aggregates the capital raised from the investors and then loans that capital to the bank holding company. The bank holding company pays interest to the trust, which it can deduct from its taxes, and then the trust passes along those interest payments to the investors in the form of a dividend. So the bank holding company is able to raise Tier 1 equity while at the same time deducting the interest payments from taxes. The Collins Amendment applies, basically breaks down bank holding companies into three different groups. The smallest banks, which have less than $500 million in assets at the end of 2009, would be completely exempt from the rule. So they can continue to issue TruPS and count those as Tier 1 capital. On the other side, the largest banks, or those with $15 billion in assets or more at the end of 2009, can no longer use any TruPS to count as Tier 1 capital. They can still issue them, but they won't be able to count them towards Tier 1 capital. The banks in the middle, so between $500 million in assets and $15 billion in assets, can count TruPS issued before May 19th, 2010 as Tier 1 capital, but any other TruPS can at no time be considered Tier 1 capital. Based on the Bloomberg Government estimates, Citigroup would feel the largest impact based on their outstanding TruPS at the end of 2010. Citigroup, we estimate the tax benefit from TruPS that will eventually go away to be about $500 million, which represented about 23% of their 2010 income tax expense. Bank of America was next. We estimated a tax benefit from their TruPS in 2010 at $496 million. That's about, just a little over half of their income tax expense. And then third on the list, JP Chase has about a $400 million estimated tax benefit, which in 2010 represented about 5.5% of their income tax expense.